Predicting a cryptocurrency's price requires both technical and fundamental analysis. The technical approach focuses on mathematical indicators based on historical market trends, while the fundamental analysis looks at the same economic factors that drive other markets. Aside from network adoption, these factors include regulatory changes, media coverage, and major news events. Prediction markets also differ from traditional markets, as participants purchase outcome shares instead of long and short contract tokens. 1. Technical analysis. Technical analysis is a method of predicting cryptocurrency prices that involves studying past market data, primarily through price charts. It is based on the core principles that the market discounts everything, prices move in trends, and history tends to repeat itself. Traders and investors use this information to make educated guesses about future market behavior and make buy or sell decisions accordingly. Crypto market prediction is a challenging endeavor, and the fact that many forecasters are wrong more often than not should give everyone a healthy dose of skepticism when new predictions pop up. However, if you're willing to invest the time and effort to learn how to interpret trading charts and identify market trends, you can develop a strategy that can help you get more out of your cryptocurrency investments. The first step in understanding how to predict crypto prices is to understand the basics of trading charts. Candlestick charts are a popular choice because they provide a nuanced view of the market by showing price movements within specific time frames. The color of each candlestick reveals the strength of buying and selling pressures and signals market momentum shifts. Traders can also use other charting tools like moving averages and indicators to identify trends and predict future prices. For example, an exponential moving average (EMA) line shows an uptrend if the current price of a digital asset is above the EMA, while a downtrend occurs when the price is below the EMA. The EMA indicator also provides an indication of the trend's direction and velocity. Traders can use other indicators to gauge the trend's momentum, such as the Relative Strength Index (RSI), which can show whether an asset is near its bottom or top. Aside from using charting indicators and examining past market data, it's important to consider other factors that can impact the market, including news, partnerships, and plans for the development of a cryptocurrency project. These may influence public perception of a project, or the broader economy, and can reshape fundamentally based estimates of its growth. Similarly, scarcity, mainstream adoption, and regulation can all have an impact on how a cryptocurrency is perceived by investors and the prices that it fetches in the market. 2. Fundamental analysis. Cryptocurrency fundamental analysis is a method of determining the underlying value of digital assets. It requires an examination of the project's funding sources, business model, and market trends. It also involves looking at the cryptocurrency's tokenomics, including its core team, early investors, white paper, and previous project accomplishments. While this type of analysis is commonly associated with traditional investing, it's becoming increasingly popular in the cryptocurrency space as well. It seeks to determine the fair market value of a given asset, and it assumes that the market price will gravitate towards this value over time. Traders can then make decisions about whether or not to buy or sell a particular asset based on this information. This approach requires a broad understanding of the cryptocurrency market, and it can be challenging to assess its overall health when there are so many different moving parts. To make an accurate assessment, it's necessary to consider several factors, including market capitalization, trading volume, and other metrics that track investor activity on the blockchain. These metrics can be influenced by a variety of different factors, including how easy it is to transfer coins from one wallet to another, particularly on blockchains with low transaction costs. In addition to these metrics, it's important to monitor major news events and other global economic trends that may affect cryptocurrency prices. For example, a spike in inflation is often followed by higher interest in Bitcoin as an alternative store of value. It's also helpful to keep an eye on regulatory changes and other industry developments that could impact a particular cryptocurrency's market. Technical analysis thrives in crypto due to its high volatility, and it uses specific tools and patterns to predict prices. Traders can look for recurrent price patterns, as well as chart indicators like moving averages and oscillators to identify potential opportunities. They can also pay close attention to social media and other forms of public opinion to gauge investor sentiment. Finally, they should stay informed about overall market trends and bullish and bearish forecasts to understand how these factors can affect a cryptocurrency's price. 3. Market sentiment. Market sentiment is the collective mood and attitude of investors in the crypto space, which can affect supply and demand dynamics. It can also override technical and fundamental analysis, making it an important factor to consider when developing trading strategies. Positive sentiment can propel prices higher, while negative sentiment can cause them to fall. Sentiment can be measured by studying social media posts, news articles, and community conversations on forums like Reddit, Discord channels, or Telegram. Generally, if the majority of sentiment is overwhelmingly positive, it indicates an increased demand for the cryptocurrency, which can lead to a rise in price. Conversely, if the majority of sentiment is incredibly negative, it could indicate a decreased demand for the cryptocurrency, which would cause the price to fall. It is also possible to use algorithms that analyze and interpret raw blockchain data to gauge the overall sentiment of a coin or token. However, this can be a complicated process for most investors and traders, which is why there are several platforms that provide automated sentiment analysis and data collection. These include DeFi Llama, June, and CoinGecko. One popular way to measure investor sentiment is through the Fear and Greed Index. This indicator is based on the notion that extreme fear tends to lower asset prices, while extreme greed leads to high prices. By using this indicator, you can determine whether the current market is fearful or greedy, which can help you predict future price movements. Performing an analysis of market sentiment can be a powerful tool for predicting cryptocurrency prices, but it's important to combine it with other methods, such as technical and fundamental analysis. This way, you can make informed decisions and maximize your profits. It's also important to understand how different factors can impact market sentiment, such as a major announcement or event that may affect the price of a particular cryptocurrency. For example, if Tesla CEO Elon Musk tweets about Bitcoin, it can have a significant impact on the price of that cryptocurrency and other cryptos, as people react to his opinions and feelings. 4. News impact. The crypto market is inherently volatile, and news events can play a major role in shaping prices. Negative news can send shockwaves through the market, fostering FUD and triggering panic selling. Positive news, such as increased regulatory clarity or a positive endorsement from a high-profile figure, can elevate specific cryptos and boost investor confidence. Technological advancements like blockchain innovations or new platforms can also impact cryptocurrency prices. As the crypto market continues to grow, it's important to understand how news impacts volatility. Volatility discourages prospective buyers and can lead to large losses for inexperienced investors. A deeper understanding of the complex interplay between news and price fluctuations can help you navigate the crypto market with confidence. FUD, fear, uncertainty, doubt, is a key driver of cryptocurrency prices. Fear of missing out on a bull run can cause a frenzy, fueling rapid price surges and creating a self-fulfilling prophecy. While doubt and caution can also trigger negative market reactions, they tend to have a more tepid impact on prices than fear. Moreover, the effects of negative news can be amplified by social media and other influential sources. For example, in 2022, the fourth largest digital currency Terra Classic collapsed after a price surge followed by a fraud investigation. This isn't an isolated incident. Payment coins that rise by 10,000% or more typically lose 90% of their value in the years following their massive price surges. Political events can also influence cryptocurrency prices. Candidates' positions on various issues, such as their stance on the future of money and finance, can sway markets. For example, President Trump's recent shift towards pro-crypto policies in support of a Bitcoin reserve suggests that his presidency could be friendly to the industry. Similarly, Democratic candidate Kamala Harris's reiteration of her commitment to decentralized finance could also be a positive development. Another way to predict crypto prices is by using prediction markets. These are online platforms where users can trade on the likelihood of an event occurring. For example, the yes share in a market on whether Sam Bankman-Fried will be sentenced to more than 50 years in prison represents the current probability that he will receive such a verdict.